NVIDIA is the undisputed king of artificial intelligence. Every headline, every earnings call has pointed in one direction. But pull up the year-to-date returns for every major semiconductor stock in 2026, and the leaderboard tells a very different story. The top is dominated not by chipmakers, but by storage companies. Names most investors have completely ignored. Sandisk, up 209%, a company most people associate with the SD card in their camera. Behind it, Western Digital, Seagate, and Micron, all storage, all outperforming NVIDIA by triple digits. NVIDIA is not second. It is not fifth. On the year-to-date semiconductor leaderboard, NVIDIA is third from the bottom. To understand why this is happening, you need to understand two distinct phases of artificial intelligence. The first is training. This is the phase everyone talks about. Companies assemble massive clusters of GPUs, sometimes tens of thousands of them in a single facility, and they process trillions of data points over weeks or months. The goal is to build a model from scratch, and it requires extraordinary computing power. The second phase is inference. This is what happens after the model is built. Every time you open ChatGPT and type a question, every time Gemini summarizes your inbox, every time Claude drafts a document, that is inference. The model is not learning anything new. It is applying what it already knows over and over, millions of times per minute. Now here is the critical distinction that most investors miss. Think of building a highway. You need the excavators, the concrete, the construction crews, but only to build it. Once it opens, those machines go away. What runs on it forever is the trucks, every delivery, every route, every hour of every day. Training is the construction phase. You pay the bill once, it might be $50 million, it might be $500 million, and then it is done. Inference is the trucks, they never stop. Every query, every user, every single second. And every new app that connects to that highway adds another truck to the road. The traffic is not just growing, it is compounding. When researchers at Epic AI modeled the lifetime cost of a large language model, they found something striking. Within the first 12 to 18 months of deployment, inference costs exceed the original training cost. After 2 years, inference is 3 to 5 times more expensive. After 3 years, the gap is an order of magnitude. Even Jensen Huang acknowledged this shift publicly. At GTC 2025, he told a room of investors and engineers that inference would become the dominant workload for AI computing. His exact framing positioned NVIDIA as the solution to that challenge. But the market data that followed told a more nuanced and complicated story. Because inference does not just need processors, it needs storage, enormous amounts of persistent, cost-efficient, reliable storage. And when you compare the cost per gigabyte across the 3 main storage technologies, the economics diverge dramatically. High-bandwidth memory costs roughly $10 per gigabyte, NAND flash costs about 10 cents, and a traditional hard drive costs less than 2 cents. Training is a spike. A massive, expensive, finite spike. Inference is an ocean. It stretches in every direction and it never stops growing. Now, with that framing in mind, let us look at what the stock market is actually pricing in this year. Because the leaderboard we glimpsed a moment ago is not a one-week anomaly or a short squeeze or a meme stock phenomenon. It has been building consistently since the fourth quarter of 2025. And it reflects a fundamental reassessment by institutional investors of where the real value creation in the AI supply chain is happening. Here is the full semiconductor leaderboard for 2026 year to date. At the very top, Sandisk up 209%. That is more than a triple from where it started the year. Below it, Western Digital up 83%. Then Seagate up 75%. Then Micron up 33%. All 4 are storage and memory companies. Then there is a significant gap. AMD sits at 10%. Broadcom is roughly flat. And NVIDIA, the stock that defined the AI rally for 2 straight years, is down a fraction of a percent, essentially flat. The company that built the infrastructure for training is being left behind as the market shifts to pricing in the infrastructure for inference. Let that number sit for a moment. Sandisk has delivered 209% returns this year. NVIDIA has delivered 0. The divergence is historic. Now, Sandisk is not a glamorous company. It does not have a celebrity CEO or a keynote with laser shows. It makes the flash storage you find inside phones, tablets, cameras, and USB drives. It was originally acquired by Western Digital in 2016 for $19 billion, then spun back out as an independent company in 2024. Most investors barely noticed the spin-off. It received almost no coverage from financial media. But look at the one-year price chart. The stock has tripled from its post-spin-off low, and the trajectory is unmistakable. The initial climb began in mid-2025, but the real acceleration started in the fourth quarter, right when hyperscaler capital expenditure guidance began shifting explicitly toward inference infrastructure. This is not a meme rally. The buying has been led by institutional investors, pension funds, and quantitative strategies that are repositioning their semiconductor exposure away from pure-play GPU names and toward the storage layer. Now, this is where the story gets genuinely interesting, because Sandisk is not acting alone. 4 storage and memory companies sit in the top 5 of the semiconductor leaderboard: Sandisk, Western Digital, Seagate, and Micron. That is not a coincidence. It is not just sector rotation where money moves from one group to another for no structural reason. And it is not momentum chasing, where algorithms pile into whatever went up last week. These companies are being systematically repriced by the market because analysts and institutional investors are recognizing that the AI spending wave is shifting from a training-dominated phase to an inference-dominated phase. And inference, by its very nature, requires dramatically more storage per dollar of compute than training ever did. 4 names, 4 companies that most investors had written off as legacy technology. One unmistakable signal about where the market is headed. To understand the scale of what is driving this shift, you need to look at the companies actually building AI infrastructure. These are the hyperscalers: Amazon Web Services, Google Cloud, Microsoft Azure, and Meta. These 4 companies are collectively spending at a pace that has no precedent in the history of corporate capital investment. They are building data centers on every continent, hiring at extraordinary scale, and placing orders for hardware that stretch years into the future. And the composition of that spending is changing in a way that directly benefits the storage industry. In earlier rounds of AI investment, the overwhelming majority of CapEx went to GPUs and networking equipment. The logic was simple: buy more compute power, train bigger models. According to a Bloomberg intelligence analysis published in February 2026, total hyperscaler capital expenditure across the Big Four is on track to exceed $500 billion this year. That would represent a 32% increase over 2024 levels. Here is the quarterly breakdown from the beginning of 2023 through the first quarter of 2026. You can see the shift in composition clearly. In 2023, GPU and networking hardware dominated. By the second half of 2024, storage began claiming a larger share. And in the latest quarter, the storage and memory category has grown to represent roughly a third of total spend. This is not a marginal shift. This is a fundamental reallocation of hundreds of billions of dollars, and it is flowing directly into the revenue lines of the companies we have been discussing. The absolute numbers are staggering. Total hyperscaler CapEx is moving from $380 billion in 2024 to an estimated $500 billion in 2026. Now, it is important to be precise here. Not all of that $500 billion goes to storage. GPUs and networking still claim the largest single share, but the storage portion has been growing faster than any other category for 6 consecutive quarters. Data centers are not just buying more GPUs. They are building the infrastructure to keep those GPUs fed with data around the clock. That means NAND flash for hot storage, DRAM for caching, and increasingly, high-capacity hard drives for cold storage and archival. Storage as a share of total hyperscaler CapEx has moved from approximately 18% in 2023 to an estimated 31% in 2026, nearly doubled. Meanwhile, NAND flash prices have entered a new upcycle. After bottoming in the middle of 2024 following 2 years of oversupply, spot prices have climbed roughly 40%. This is the typical semiconductor cycle at work. Oversupply leads to price cuts, which leads to capacity reductions, which eventually leads to a supply squeeze. But this time, the amplitude is being amplified by a new source of demand. AI inference is layering structural, persistent buying on top of the normal replacement cycle. Inside the fabrication plants that produce these NAND chips, the pressure is visible. Cleanroom capacity is running at utilization rates above 90% at Samsung, SK hynix, and Kioxia. Several companies have announced plans to pull forward expansion timelines that were originally scheduled for 2027 or 2028. The industry is investing as fast as it can, but demand is growing faster than capacity can follow. Industry trackers like TrendForce and DRAME Exchange are projecting NAND bit growth of 35% in 2026. That would be the highest annual growth rate since 2021, when the pandemic drove a surge in consumer electronics demand. 4 vectors are converging: hyperscaler spending, NAND pricing, HDD demand, and inference growth. All of them point in the same direction, towards storage. Now, broad industry data only tells part of the story. To truly understand why the market is rewarding these specific companies so aggressively, you need to look at them individually. You need to examine the earnings, the guidance, the product roadmaps, and the competitive dynamics that are unique to each one. Let us start with Micron, the most diversified player in this group. Micron Technology is headquartered in Boise, Idaho. It is the only major American manufacturer of both DRAM and NAND memory. For the past 2 years, most investors have known Micron primarily as a supplier of high-bandwidth memory, the specialized DRAM that sits on top of NVIDIA's GPUs. That product has received enormous media attention, but it represents a surprisingly small share of the company's actual revenue. In Micron's most recent quarter, the fiscal first quarter of 2026, HBM accounted for roughly 6% of total revenue. Just 6%. The other 94% came from conventional DRAM and NAND sold to data centers, mobile device manufacturers, automotive companies, and enterprise customers. This is the part of Micron that the market is now repricing, and it dwarfs the HBM segment. Think about it this way. Every phone that ships has NAND flash inside it. Every laptop, every tablet, every cloud server, every connected car. And the amount of storage per device is growing every year. AI applications accelerate that trend dramatically because they generate and consume data at rates that traditional software never approached. Micron's one-year stock chart shows a steady upward trajectory, with the sharpest acceleration following the fiscal first quarter earnings report. Revenue grew nearly 30% year over year, driven primarily by strength in data center DRAM and enterprise NAND. Gross margins expanded significantly as rising NAND prices flowed directly to the bottom line. The stock gapped up 12% on the day of the report and has continued climbing in the weeks since. Management raised guidance for the full fiscal year and specifically highlighted AI inference workloads as the fastest-growing demand driver for both DRAM and NAND products. They noted that inference-related revenue doubled year over year in the quarter. Micron's operating margin moved from 11% to 28% in just 3 quarters. That kind of margin expansion signals a company riding a structural demand wave. Now, here is what makes this even more striking. Compare Micron to the other three storage leaders on a year-to-date basis. Despite its strong fundamental performance, Micron is actually the weakest performer of the four. Sandisk, Western Digital, and Seagate have all outperformed it by wide margins. That tells you just how powerful the broader storage and memory trade has been this year. Now, Micron's story is fundamentally about memory, about DRAM and NAND flash. But the second case study is about something that most investors would consider even more unlikely. It is about the resurgence of old-fashioned mechanical hard disk drives, and the company leading that resurgence is Seagate. If there is one piece of technology that the tech industry has collectively assumed was dead and buried, it is the hard disk drive. Spinning magnetic platters, mechanical read-write heads, a fundamental design architecture that dates back to the 1950s. For over a decade, the consensus has been overwhelming. Solid-state drives would make spinning disks completely obsolete. Headlines from 2018 and 2019 routinely declared the imminent death of the HDD. Industry analysts projected that NAND flash prices would fall fast enough to make hard drives irrelevant for all but the most niche applications by 2025. But here is the problem with that prediction. It ignored the economics. SSD storage still costs roughly 15 cents per gigabyte at the enterprise level. Hard drive storage costs about 1.5 cents per gigabyte. That is a 10-to-1 cost difference. And for hyperscale data centers that need to store petabytes of training data and inference logs, that cost gap is decisive. Now, Seagate has not simply survived by selling the same old product at lower prices. It has innovated. The company's latest generation of enterprise drives uses a technology called HAMR, which stands for heat-assisted magnetic recording. During the writing process, a tiny laser heats a precise spot on the disk surface, temporarily altering the magnetic properties of the material. This allows data to be packed more densely than was previously possible. The result is 30 terabytes of storage on a single 3.5-inch disk. To put that in perspective, that is roughly equivalent to the entire digitized collection of the Library of Congress. The entire Library of Congress on one tray. That is not a marketing slogan. That is a shipping product sitting in data centers today. Seagate's stock price tells the story clearly. Up 75% year-to-date, driven almost entirely by a single factor: hyperscaler demand for high-capacity nearline drives. The company's order book hit an all-time record in its most recent quarter, and management indicated that visibility into future demand extends well into 2027 and beyond. On the earnings call, Seagate's CEO told analysts that every major cloud provider has either placed new orders or expanded existing commitments for HAMR-based drives. The technology transition is no longer speculative. It is commercial and accelerating. Now, let us connect the individual pieces into the broader mechanism. The force driving all of this, from Sandisk's flash revenue to Seagate's hard drive backlog to Micron's margin expansion, is the explosive growth in AI usage at the consumer level. ChatGPT alone has crossed 700 million weekly active users as of early 2026. When you add Google's Gemini, Anthropic's Claude, and the dozens of smaller platforms, the combined figure reaches an estimated 1.3 billion weekly active users. A recent paper from researchers at UC Berkeley estimated that inference now accounts for more than 80% of all AI compute cycles globally. Training gets the headlines, but inference dominates the actual workload by a wide margin. And every single one of those inference queries generates data: prompt logs, response caches, embeddings, fine-tuning datasets. At current volumes, that translates to approximately 200 petabytes of new data generated per day across major platforms. Training is a spike. Inference is an ocean. We said it before, and now you can see the numbers behind it. The ocean is growing faster than anyone predicted. And this dynamic is not slowing down. It is compounding. Every new application that integrates AI, every enterprise that deploys a chatbot, every consumer who discovers a new AI tool adds another permanent layer of inference demand. And each layer requires storage. Storage for the prompts, storage for the responses, storage for the model weights, storage for the fine-tuning data. The storage layer is not optional. It is the foundation that everything else in the AI stack sits on top of. If training was the match that lit the AI era, inference is the fire that keeps it burning. And fire needs fuel. In this case, the fuel is storage. NAND flash for the data that needs to be accessed quickly. DRAM for the data that needs to be accessed instantly. And hard drives for the vast ocean of data that needs to be stored permanently at a cost that does not bankrupt the companies building this infrastructure. That is the mechanism. That is why 4 storage companies sit at the top of the semiconductor leaderboard. Now let us consider the risk. The obvious question is, what happens if the AI bubble bursts? What if corporate spending pulls back sharply? What if the inference growth curve flattens? These are legitimate concerns, and they deserve a serious answer. Even in a severe correction scenario, one where total AI spending falls by 30% from current levels, inference does not go to zero. The models are already deployed. The users are already there. The integrations are already built. A pullback would absolutely slow the rate of growth, but it would not eliminate the underlying demand for storage. The data that already exists still needs to be stored. Think about it this way. During the dot-com crash of 2000 to 2002, internet usage kept growing. Email volumes kept climbing. Web traffic kept increasing. The companies that collapsed were the ones making promises. The companies that survived and thrived were the ones providing essential infrastructure. Storage is essential infrastructure. In the most conservative analyst models, inference workloads still grow at 15 to 20% annually through 2030. Even the bear case implies significant ongoing demand for storage. Once a billion users are asking AI questions every day, you cannot undo that behavior. You cannot delete the data. You cannot shrink the ocean. You cannot unring that bell. Now, to be clear, this is not investment advice, but the signal from the market is unmistakable. The AI investment thesis is migrating. It is moving from the flashy front end to the essential back end, from processors to storage, from training to inference. If you are thinking about where the AI supply chain is headed, 3 words summarize the current market assessment. HBM, approach with caution. NAND flash, the price floor is in. Hard disk drives, structural growth ahead. Thanks for watching. If you are not subscribed yet, now is a good time. See you in the next one.